Thank you, everyone, for being here today. My name is Lori Henning. I am the Executive Director for the Texas Association of Goodwills. I'm speaking on behalf of the Texas Fair Lending Alliance. We're a coalition of over 60 organizations from across the state that are concerned about payday and auto title lending in Texas and the drain on family and community resources that's often caused by what you're hearing today, the cycle of debt created by these loans. I want to emphasize here that we support access to credit, but it must be credit offered with fair terms. Right now, we have a market with a set of financial products that appears to thrive on continued borrower failure or repetitive refinancing. We want to see this market move from one driven by a cycle of debt to one based on a cycle of borrower and lender success. As a voice for Goodwills across Texas and a former vice president of branch operations for the Gulf Coast region, I understand businesses and profit. Goodwills are businesses, and we believe in free market and the power of competition. Last year, our retail operations were over $206 million. We compete like any other business. We also understand and promote personal responsibility and the need for consumer choice for short-term loans. However, the effects of payday and auto title loans on our clients and employees have caused us to take a second look at this. Goodwill's mission is to enhance the dignity and quality of life for individuals and families through learning and the power of work. We found these loans were undermining our work in our communities, with an increased number of people, both our employees and the clients we're serving, caught in payday and auto title loans. Ones that had struggled to own a car free and clear, losing their car to an auto title business, often after they had paid more than they borrowed in fees alone. And along with losing their car, they lost their way to work, to shop, and to take their kids to their activities. Allow me to share some examples for you. The cycle of debt trapped Evelyn from Houston, who paid over $4,000 for a $1,500 auto title loan, and she still lost her car. It cost Sunny, a single mom and West Texas Goodwill employee, her home, as she could no longer afford her monthly payments after taking out a second payday loan to pay off the first one. It trapped Petra, a San Antonio senior citizen who had to move in with her daughter. It trapped an El Paso college student who used a payday loan to buy books for school and ended up rolling the loan over and over again, never paying down the principal. A recent survey of nonprofit clients conducted by the Texas Catholic Conference found that 32% of our clients have been caught in a payday or auto title loan cycle. This is a 44% increase in the last 2 years. These are numbers we cannot ignore. The effects of the cycle of debt extend to our churches, our nonprofits, social service agencies in your community, and many organizations across the state that are trying to provide safety nets for working families, students, and senior citizens. This is the bottom line issue for both Goodwill and the partner organizations in our alliance. Now, I know you've heard a lot of data today, but I want to highlight one key finding that I think is really important and that addresses your question about what's happening in other states. Texas are paying more for payday and auto title loans than almost in every other state. And let me illustrate this. You take out a $500 loan for a payday loan. You have about 2 weeks to pay that back. In Texas, you'll pay a $115 fee for that loan. For that $500 in Oklahoma, it costs you $65. Same industry, same amount of money. Same company loaning you the money. In Florida, the same company loaning you $500 only charges $55 for that loan. It begs us to question, why are Texans paying more for these loans?
Yeah, could I answer the question?
Mm-hmm.
So I just want to, I'm trying to figure this out. So would y'all be okay with the $55 that they charge in Oklahoma?
Yes, I would be.
And what about the $65 they charge in, well, I don't know which state that was.
You know, I think seeing that kind of improvement in the fees, I think that the coalition and the advocacy groups would be very supportive of that. Would you agree with that, Susan?
It would certainly be better than what's going on right now.
I mean, obviously it's less than what's going on today. I mean, I just want to know, is there some kind of amount that is out there that y'all decide, that y'all figured out this is okay and this is not okay?
Mm-hmm.
I mean, where
I don't
is
think
that?
we've come with a come up with a single number. I know that across the country, 15 on 100, somewhere between $10 and $15 per 100 borrowed seems to be standard. I know that some of our folks will still have a problem with 15 on 100 because that translates to 390% APR.
Well, I know a lot of people have a hard time with their credit card payments that they have, and they're in debt,
sure.
and they're causing troubles at their homes. You know, they're having problems in their home. I mean, the same things. It's just a matter of which level structure of society you are. I'm just curious, I mean, because you say those two, and I just wanted to see if it was 65 or 55 or somewhere in there that would.
Well, I think, Stephen's saying somewhere between 10 and 15. I think a lot of people could wrap their arms around that. Right now, it's closer to $23 to $24 per 100. So that's a significant difference. The other thing, and I'm going to skip that because Stephen already covered that 35,000 cars were repossessed, and that information is from the OCCC data, which you have. Our goal is to move statistics towards more consumer success, and when I put this in a 1, 2, 3, it sounds so simple. So Texans aren't paying more. 2, we want more borrowers to be successful in repaying their loans on time. If it's a 2-week loan, can they pay it in 2 weeks? And 3rd, we want fewer Texans to lose their cars. It seems like a pretty straightforward approach. I'd like to conclude with solutions that we believe are essential to fair and reasonable legislation. We also are considering and are considerate of the 4 million Texans that are covered right now under the new city ordinances. Texas Fair Lending Alliance believes that fair products support a healthy economy for Texas, and to that end, solutions should include the following 5 things. Tight product definitions, limiting credit offerings to payday and auto title loans is defined under law, so there are no loopholes, that they can't create new products, that they can't go around what your intentions are. 2, limitations tied to the ability of the borrower to repay the loan in the original loan term. This includes looking at the borrower's ability to pay and realistic limits on loan amounts that take into account family budgets. I get really concerned when somebody tells me they have an auto title loan or a payday loan that's higher than their mortgage note or higher than their mortgage, their car note, and their electric bill. That concerns me. The 3rd is a clear repayment path for borrowers, ones that fit the definition of short term. You've heard this already today. A 30-day loan that extends to 6 months is not a short-term loan. 4, workable enforcement mechanisms. And 5, fair and visible pricing so that we can foster a truly competitive marketplace on cost. A lot of people within the coalition have gone to visit these stores, and they're not finding it obvious to them how much this is going to cost them. It's just not clear, so it's really hard for customers to really do comparative shopping unless they hear maybe an advertisement on the radio. So I think we really want some true, obvious information that people can look at before they're signing on the line or they've made an agreement. How much is this really going to cost them? And we want to make sure that Texans are not being charged some of the highest fees in the country for these loans. Thank you.